We'll pay you 10, 12, 15% more to buy your silver. You just ship it to us and you'll make a gazillion dollars. Same thing with gold, $85, $90, $100 premium on gold. So ship it. Now, arbitrage doesn't last long. Normally, the traders fill that gap quickly. Dissent, who understands gold, could he be the one saying to the banks, we want to stay at arm's length. We don't want our footprints in the snow, but you're going to buy a ton of gold for us. You're going to put it into the COMEX and leave it in your house account. We'll get it when we want it. We don't have to worry about any shenanigans on the COMEX or the U.S. Treasury. And if we pull it all, when you throw into the mix that Van Eck Fund says if the dollar really did lose reserve status, we could see, and this is their emerging market bond team, so we could see gold go to 139,000 an ounce. So is gold going to be revalued? We've talked about how James Rickards says 24,000 and how Luke Groman keeps lasting. They're playing the long game. And so you play against the Western foolishness of, as Rick Rule says, they're trading 200 times more silver than is deliverable every day on COMEX.
Where does gold fit in here? How does gold become the trust layer underneath the system?
Because no one trusts treasuries any longer, and that's the truth of it. And you can see that. I know it's only been a couple of days, but recently we've seen the 30-year treasury go up and the dollar go down. Now, normally they're supposed to move together. I mean, you would think that the Western, the U.S. dollar, the global reserve currency, the epicenter of trust, right? If interest rates go up for whatever reason, usually a strong economy, you're going to see interest rates start to go higher, get fear of inflation or whatever it may be. But as interest rates go higher in the dollar, it usually would be more demand for return. And so people would flood into the dollar. The dollar should go up. We're seeing interest rates go up and the dollar go down. That's an ominous sign. Now, 2 days does not make a trend, but if you continue to see the dollar go down and rates go up, that is further proof that the world is tired of holding U.S. treasuries, not only because of the fiscal and monetary hurdles that we have to overcome, which seem insurmountable, maybe are mathematically, but also the lack of trust in our foreign policy and in what happens if you end up on the wrong side. Like maybe this is why India and Saudi Arabia are straddling, if you will, and very much so. Saudi Arabia, differently than India as a charter member of BRICS, India, but they both seem to straddle both sides of the fence, placating to the West while still being heavily involved in the BRICS. You look at Saudi Arabia, who hasn't made a formal decision yet, is a charter member of Enbridge, which would be one of the catalysts to hurting the dollar more than anything. And so I think that it's becoming very real.
Rising yields are not the real warning. Rising yields with a falling dollar is the real warning. As Andy Schectman notes, the divergence breaks the usual relationship where higher treasury returns attract capital into dollars. It could signal foreign investors demanding more compensation while reducing exposure to US debt. For savers, persistent divergence threatens purchasing power even without a market crash. Next, Andy Schectman exposes why central banks may be preparing for that shift.
It's just a matter of how does this all play out? I don't think anybody knows, but I think it's something that is becoming very difficult for the West to do much about. And I guess we'll have to see how many new countries are admitted into the system or into the new BRICS platform. But I think everything that they are doing from payment rails to precious metals, where it is a system that it's an asset that requires no counterparty fulfillment. It's an asset that has value independent of any counterparty, no counterparty risk if it's held in your own possession. And we're seeing that. We're seeing the central banks buy more gold than at any time ever, year over year over year, 1,000 tons plus 3 years in a row. The central bank said that they bought 16 tons the first quarter, and the World Gold Council said you're lying by a factor of 15. Now, you've actually bought 15 times more than you said. Why are you lying? And the same thing, Goldman Sachs said the same thing about China. I think it was 4.5 times understated or whatever the number is. But the central banks are reporting voluntarily and they're underreporting purposely. And if you watch, you can see the massive purchasing by the central banks that isn't stopping. And here again, massive second quarter purchases by the central bank, huge. second quarter purchases by the central banks, if we believe them that the numbers are what they say. But remember, all of this purchasing we've seen this year, Michelle, has happened as the price has gotten clubbed. And so what do they know about where this is ultimately going when they continue to purchase hand over fist at a time when the price has done anything but go up in dollars? Certainly it's gone up in Japanese yen, but they're buying it, and they're buying it at a level that is unlike anything anyone's ever seen, and they're doing it and not being honest about it, as we have found out.
Central banks are buying gold aggressively while its dollar price struggles, and that contradiction deserves serious attention. According to Andy Schectman, purchases have exceeded 1,000 tons annually for 3 consecutive years, while some reported figures appeared materially understated. Why keep accumulating during weakness if gold's strategic role is supposedly fading? For investors, that behavior suggests institutions may value insurance over short-term price performance more than public guidance. Next, Andy Schectman reveals what those purchases imply.
So far this quarter, the second quarter, we've already seen a 407% increase quarter over quarter, or 231 tons. So year to date, they bought 345 tons. And that they've claimed. And Poland has bought 82 tons. And that's the same Poland, by the way, where they asked Adam Glapinski, I've said this before, why is Poland buying so much gold? Because we buy gold, and the Central Bank of Poland buys gold because when someone pulls the power to the global financial system, one that is dominated by electronic accounting records, we want to be able to be prepared for even the most unlikely circumstances. Now, something to that extent, you have the head of the Polish Central Bank buying more than anyone, including China, for 3 years in a row, and they say they're buying it for other reasons than most would think, because when someone pulls the power on the system. By the way, Adam Glapinski also has gone on record recently and said that these pullbacks that we've seen so far this year has been nothing but an opportunity for Poland to add more gold to their reserves, as we can see it at 82 tons that we know for sure have been purchased this year. So the biggest money in the world is accumulating gold as if they know something. And who's doing it here at home? And that's the thing that, I get some flack sometimes, Michelle. People say, well, it's not leaving. Some leaves COMEX, some doesn't. Is it just the central banks playing, or the commercial banks playing games? My answer to that is no, because they never did this before. They never, ever stood for delivery. Less than 1% of contracts did. They would cash settle, they would exit the trade, or they would roll forward. Now they want numbered bars in their account. And my question is, much like Tether buying huge amount of gold so far this year, continuing, in fact, Tether's bought more gold than anyone but Poland for the last 2 years. Who's doing it? And could it be the Exchange Stabilization Fund, the cent, who understands gold? Could he be the one saying to the banks, we want to stay at arm's length?
The biggest signal may not be gold's price, but who keeps demanding the metal behind it. What Andy Schectman is highlighting is this shift from paper exposure toward identifiable physical bars alongside Poland's reported 82-ton accumulation. That matters because physical possession removes counterparty dependence when electronic settlement systems face disruption. Investors should watch delivery behavior more closely than daily futures volatility. Next, Andy Schectman exposes why physical demand can reveal institutional intent before official policy does.
We don't want our footprints in the snow, but you're going to buy a ton of gold for us. You're going to put it into the COMEX and leave it in your house account. We'll get it when we want it. We don't have to worry about any shenanigans on the COMEX or the U.S. Treasury. And if we pull it all out, well, they'll be able to follow the footsteps. Let's leave it there. And it makes the analysts in this industry say, well, couldn't it just be the banks playing a game? No, it's not, because they do the game with paper and warrants, not with physical delivery. And I think the same thing should be asked about Tether. We can talk about that if you want, but the bottom line is that gold is being rewoven into the monetary system quietly here and far more overtly across the globe.
Right, and I will get into Tether and the potential U.S. connection there. But to your point, we are seeing central banks buying gold at record levels. Interestingly enough, Poland, who's not part of the BRICS, a big proponent of gold purchasing and not even necessarily linked to this alternative railway that's being built. But it's pointing to that broader trend of de-treasurization and accumulation of gold. And, one of the pillars in your thesis here, as this multipolar financial infrastructure gets built, is the architecture, the plumbing. But, you touched on this, and that's the exchanges and price discovery, because another pillar of your thesis, which I find very interesting, is what is the real price of things, price discovery. And I think that is a point that often gets overlooked here, Andy, because a lot of the discussion focuses on payment systems and local currency settlements. But we're also seeing efforts to build entirely new marketplaces here. We've got the BRICS agricultural ministers reaffirming plans for the BRICS grain exchange. Russia is saying that project has now entered its design phase. And officials have also discussed a BRICS precious metals exchange, all while Hong Kong is continuing to expand its yuan-denominated gold pricing and emphasis on physical.
The uncomfortable possibility is that physical gold accumulation may be serving a purpose markets cannot easily see. Andy Schectman's argument suggests that if institutions wanted only price exposure, paper contracts would provide cheaper flexibility than taking delivery. Yet new exchanges, physical settlement, and alternative pricing centers point toward infrastructure rather than speculation. That distinction matters for investors because monetary systems change through plumbing before headlines acknowledge it. Next, Andy Schectman unravels why controlling price discovery may matter more than controlling payments.
So, is the objective here, Andy, to create alternative centers of price discovery? And explain why that is so important, because if you control where commodities are priced and how they're priced, how much influence does that actually give you over the global financial system? Explain that to us.
Why do you think the West has guarded that right and that privilege for so many years? Yeah, of course it does. And if you are hell-bent on doing that, the first thing you do is play the game against the West and stand for delivery, quietly, methodically play the long game and just wait everybody out. And they are doing that. We know that China produces more gold than anyone in the world, second most producer of silver. We've highlighted how they fly all around the world buying doré and concentrate, using the Western price, paying twice what the West will, and bringing it back and refining it from Peru and from Mexico. We see the deals they've struck all around the world for, gold mines and infrastructure within the Belt Road, building up the ability to withdraw these natural commodities and take possession of it. If that was your intention, and you stand for delivery in a way that you're being caught at least 2 or 3 times by entities like the IMF or the World Gold Council, or recently by Goldman Sachs, looking at the import-export numbers, recognizing it's a voluntary admission to report it, but having it accumulated by People's Liberation Army and proxy banks, and standing for delivery, playing the Western game. You guys are stupid enough to suppress the price. We'll play your game. And in fact, we'll incentivize you to do it by having a year-long 10 to 15% premium on Western silver. In other words, we'll pay you 10, 12, 15% more to buy your silver. You just ship it to us and you'll make a gazillion dollars. Same thing with gold, $85, $90, $100 premium on gold. So ship it. No, arbitrage doesn't last long. Normally, the traders fill that gap quickly.
A 10 to 15% premium for Western silver should make investors question who actually controls scarcity. This is where Andy Schectman's thesis shifts. China can exploit Western pricing while simultaneously accumulating physical commodities and building supply chain control. The critical distinction is that low paper prices can become an acquisition opportunity for strategic buyers. For long-term holders, the risk is not simply missing a rally, it is watching physical assets migrate while believing the quoted price tells the whole story. Next, Andy Schectman reveals the arbitrage contradiction.
Keeps lasting. They're playing the long game. And so you play against the Western foolishness of, as Rick Rule says, they're trading 200 times more silver than is deliverable every day on COMEX. Well, at some point, someone says, I don't want paper anymore. But if your intention, people say, why don't they just buy it all? Because if they did that, the markets would cease and they'd get nothing, squadouche. Instead, they play the long game. And people in this country cannot allow their minds to play the long game. So they look at it as dismissive. but China sure can, and so can the other countries within the BRICS framework. So they are using the Western price against us. At the same time they're accumulating, they're building the rails, the vaults, the settlement systems, and the exchanges to do this. The big one being the exchanges that are same-day settlement in another currency. We see the others in Singapore and United Arab Emirates that are same-day settlement in dollars. Same-day settlement is big enough. You put it in another currency and you very well are beginning to change the narrative. And then you look at China's playing the long game. They bought the LME, the London Metals Exchange, the base metals. They build warehouses in China to house these metals. They're playing the long game, using the suppression of Western paper prices to create an environment, the West has, of supporting the strength, illusionary strength of a bond market and of a currency that wouldn't otherwise be so strong. And we can see that by the manipulations that we see with the Western bond market and the Japanese bond market, whereby if price settlement were to really be allowed to happen through buying and selling, not suppression and loaning to the repo market and all of these things that we see, the shenanigans we see right now, then price discovery would be far different. Interest rates would be far higher, and our indebtedness would create a much bigger problem, and things would accelerate. They're playing a long game, and they at some point will be able, I think, through the majority of not only the world's commodities, but also the infrastructure that prices things appropriately, to provide that really, really substantive and very for real alternative. Doesn't mean it's going to kill the dollar, but what it does mean is it's going to change the way that everything works, and it's going to change the lifestyle of the people in this country. That's for sure.
The real threat to the dollar may be an alternative system that works without replacing it. Andy Schectman notes that China can accumulate commodities while simultaneously developing vaults, settlement rails, and exchanges outside Western control. That creates optionality, rather than an immediate currency coup. For American investors, the danger is gradual loss of monetary privilege through competing infrastructure, which can raise borrowing costs and weaken purchasing power. Next, Andy Schectman exposes why parallel systems can destabilize the existing one.
Part of the gold secret accumulation plan potentially to still come out with that gold-linked U.S. long-term treasury. I mean, Judy Shelton said she expected it. It would be nice on the 250th anniversary of the United States. Would be nice. I don't know that President Trump making that announcement at 11 p.m. with the fireworks and everything would have made sense, but just because it didn't happen on that specific date doesn't mean that that's no longer part of the vision. Is that?
I mean, I think it's the best idea I've ever heard, hers. When I put my little idea behind it, I mean, I actually could see a pathway to hope, to our kids having the same opportunity that I did and my parents did and the generation before that. You know, I mean, I think we're in trouble otherwise. I mean, I've yet to find anyone give me anything substantive on how we can dig our way out of this massive hole. And when you put into it the uneducated aspect of the populace, Dalio again says 60% of the country has a literacy rate under the 6th grade. With the indebtedness and the lack of savings, lack of education, just in time for AI to come and kill us kill the labor market when we already don't make anything because of Triffin's dilemma. It makes such great sense. Will it happen? I sure hope so. I think it would, when you throw into the mix that Van Eck Fund says if the dollar really did lose reserve status, we could see, and this is their emerging market bond team, so we could see gold going to 139,000 an ounce.
A gold-linked treasury would represent a radical response to a debt problem that conventional policy has struggled to solve. According to Andy Schectman, the idea remains strategically plausible because revaluing gold could strengthen the balance sheet without simply imposing austerity. But the $139,000 projection is highly speculative, not a forecast investors should treat as established fact. The portfolio lesson is simpler. Monetary credibility can change abruptly when debt becomes politically unmanageable. Next, Andy Schectman reveals the revaluation mechanism behind that scenario.
That's them saying this. Well, and people say, well, is gold going to be revalued? We've talked about James Rickards says 24,000, and how Luke Gromen, I think, is a smart. If I had one phone a friend guy on anything, it might be Luke Gromen, smartest dude in the world.
Yeah,
And
you're my phone a friend, Andy.
oh, thank you, Michelle. You're too kind, but
But
you
Luke
know,
Gromen,
he's a different level. And I heard him say, maybe even on your show once, that he could see it organically going to a point and then either being marked to market or revalued. But using Tether and any of the stablecoin issuers, Tether being the one that will do primary issuing, but you'll get all the banks and the insurance companies, and they'll all issue stablecoins, but they all have the same rules. They got to be backed by these treasuries. And if you get them to buy gold with the accumulated interest as part of a deal, whatever that deal is, well, you push gold to the moon.
Stablecoins could quietly become another channel connecting treasury demand with gold. What Andy Schectman is highlighting is the possibility that accumulated interest or reserves could eventually support additional gold purchases, creating demand without an explicit monetary reset. That would matter because financial institutions could participate through existing infrastructure, rather than announcing a dramatic policy shift. Investors should distinguish a plausible mechanism from a guaranteed outcome. Next, Andy Schectman exposes how stablecoin rules could unintentionally accelerate gold repricing.
You don't have to revalue it synthetically. You can let the market do it, even though it is being synthetically revalued, but yet organically. Synthetically in that treasuries are being purchased via the movement of money. That's synthetic, but taking that interest and buying gold with it is organic to a degree, synthetic also, but push gold to the moon. And by doing that, you're not doing it because you want gold buyers to get wealthy. You're doing it because you want to devalue the dollar to reshore manufacturing, to pay down the debt. In a strong dollar, you can never, ever, ever have a trade surplus. You can build all the manufacturing you want. You have to sell it. It's the same reason why the Chinese were able to win a contract on rebuilding the Oakland Bay Bridge, shipping all the materials from China, because it was too expensive here. There, it's not. That's part of being the reserve status. Currencies just depreciate against yours. To buy dollars, to buy energy and commodities, you can't do it. I don't think the BRICS want to be the reserve currency. I don't think China wants to be. They just want to make it parallel, so they're not reliant on the US dollar. And that in and of itself, because of the way the system is set up, will be very detrimental on the United States. It's not that anyone wants to be the reserve, because they see what happens to your manufacturing capacity if you are. But how about alternatives? And that's what this is all about. The ramifications simply from a viable alternative that is mature and is cooperative is the death knell to the US system. It doesn't have to replace it. And it's not going anywhere anytime soon, but just augmentation of the status quo is enough to, in an over-leveraged, massively indebted system like this, is enough to turn over the apple cart.
The dollar does not need to lose reserve status for Americans to feel the consequences. Andy Schectman's argument suggests that a credible parallel settlement system could gradually reduce foreign dependence on dollars, weakening one of America's biggest structural advantages that could pressure manufacturing, trade balances, and borrowing costs simultaneously. For savers, the key risk is a slow erosion of purchasing power rather than a single dramatic collapse.